Don't do it yourself and assume you know what you're doing, because the income is calculated so uniquely the way that lenders calculate that. Today we're talking about USDA mortgage loans, also known as RD loans. Stick around to the end of this video to find out if USDA RD loans are right for you. Welcome to your one-stop shop for anything and everything mortgage education. I post new videos every Tuesday and Saturday. Please be sure to subscribe to the channel and hit the bell to be notified. My name is Stephanie Weeks, and I'm a 16-year loan officer, also the author of the international bestseller Mortgage Peace. And I am bringing my experience to YouTube to help anyone and everyone that I can possibly have a better and more peaceful mortgage transaction. Today we're going to find out, what does RD stand for? What does that mean? What does the loan look like? Who is the loan mostly for? What can you expect in the loan experience? Is it a good loan that's right for you? RD stands for Rural Development. I cannot pronounce that word to save my life. It is R-U-R-A-L, Rural Development, aka an RD loan. This is something brought to you by the USDA Department of Agriculture. And it's a 100% loan that is a phenomenal option for those who fit in the box. An RD loan, as mentioned, is a 100% loan. It is geared toward first-time homebuyers, but it's actually not exclusively exclusively for first-time homebuyers. And that's a big misconception. So first time around, second time around, USDA RD loans might be a good option for you. Little side bit note of the day. Did you know that a first-time home buyer is defined by anyone who's not owned a home in the last 3 years? So if you owned a home years ago and now you're wanting to own a home again, you might actually still be qualified as a first-time home buyer. But remember, while RD loans are great and geared toward first-time home buyers, they are not exclusive to them. Interest rates with regarding to RD loans. As with most mortgage rates, they are very much driven by your credit score and a number of other factors. But generally speaking, an RD loan typically offers a really great interest rate in comparison to some of the other programs. Even though you're not putting a large down payment, it is a 100% loan. So if you are a first-time home buyer, or maybe a second-time home buyer, you're looking for 100% financing, you want a loan that gives you a great interest rate, even though you're not putting down a large down payment, RD could be a great fit for you. Do you pay mortgage insurance on an RD loan? So PMI is private mortgage insurance. MIP is mortgage insurance premium. With an RD loan, you pay MIP. You're going to pay an upfront premium and you're going to pay a monthly. A lot of people might be like, oh my gosh, that's horrible. Not really. I mean, don't get me wrong, anything free is amazing, but it's absolutely not horrible. So it's allowing you no money down. It's a 100% loan. Yes, you're paying mortgage insurance, but you're paying mortgage insurance monthly on a very, very small calculation in relation to other programs available. In addition to that, you do pay the upfront mortgage insurance that's rolled into the loan. You don't have to pay that in cash. So these are funds that are collected basically to keep the program going. It takes people behind the scenes to keep these programs available, and our buyers need RD loans. They're a great, great product. So while it seems like, gosh, that's terrible to have those 2 extra costs, it's really not. It helps you to help others that'll come after you. RD loans have income restrictions. That's household income restrictions. That is not borrower income restrictions. So your income is going to be analyzed from 2 angles. The angle of your debt to income and your ability to repay, but also your household income to make sure that your household does not make too much for the program. These income limits can vary state by state and parish or county, so you'll have to check with your lender to figure out where you fall in this category. They're based on number in the household. So as an example, if you are a family of 1 to 4, you're going to fall in one bracket. If you're a family of 5+, you're going to fall in another bracket. And you want to make sure that you are not exceeding those income limits in order to qualify for the program. But here is an important tip. You cannot accurately calculate your income to truly know if you're above that limit. You want your lender to do it. There are some things that we can deduct from income, and we have to calculate income in really unique ways that you probably can't reproduce well as a borrower. So unless, let's just say, if I'm making this number up, but let's just say if the income limit was $90,000 and you know you made well over 100, well, probably don't worry about it. But let's say the limit was $90,000 and you made 91 or 92. Don't just assume you're not going to qualify. Let your lender look at that for you. Remember, RD is based on household income limits. So let's say that I am a borrower and my husband is not a borrower. Even though he's not on that loan, and maybe he won't even be on that title, we still have to produce income documents for him as well as me to make sure that our household does not make too much for the program. We're producing my income documents to make sure that I have the capacity to repay and I meet the program guidelines as far as debt to income and other things. With RD loans, they are very good, 100% loans, low mortgage insurance, great interest rates, and so there's going to be some caveats that they're going to want to make sure that you fit in before they give you this loan. And one of those caveats is that they want you to have a lower debt to income ratio than some of the other programs. So as an example, where FHA sometimes will exceed a 50% debt ratio or allow you to exceed a 50% debt ratio, while conventional, they maybe want you to be below 45, but sometimes they'll make some concessions on that. And with VA, oh my gosh, sometimes they might approve with a 60% debt ratio. For the most part, RD wants your debt ratio to be 41% or less. There are a little bit of caveats to that, or a little bit of wiggle room, shall I say, but 41% or less. And I'm going to give you the same tip I gave you earlier. Don't do it yourself and assume you know what you're doing, because the income is calculated so uniquely the way that lenders calculate that. Yes, have an idea of your debt to income, but entrust your lender to make sure that you fit within that debt to income box, and don't talk yourself out of it when you may be calculating incorrectly. Generally speaking, RD would like you to have above a 640 credit score. That's generally speaking, because it can vary lender to lender, and there's also a guaranteed RD program and a direct program, and they do have different guidelines and restrictions. So generally speaking, 640 or better credit score, you want to shoot for that. Higher the better, don't get me wrong, but it's not really typically a fit for someone with really low credit scores. Who is RD not for? Well, we mentioned super low credit scores is probably not a good fit for an RD loan. We know that there's household income limits. So if you exceed those limits as a household, it might not be good for you as well. The other thing you want to keep in mind is that an RD loan is 100% loan, geared but not exclusively to first-time home buyers, and are made for people with certain household income limitations, right? The other thing, the other person or profile, shall I say, that RD is not good for is if you have a 20% down payment. If you have access to 20% down and all your closing costs and all your prepaid items, an RD loan is typically not for you. It's geared for someone who needs that 100% loan, or someone who does have savings, totally fine, but not over 20% down payment on that sales price. An RD loan is generally not geared for someone in that situation. So here's the question of the day. Overall, is an RD loan, a USDA RD loan, a good option? And my answer is yes. If it is an option for you, it could be a great option. They have a lot of great things associated with this program. They have good guidelines, they have good requirements, good restrictions, good interest rates, low mortgage insurance, no money down. So it is a really great program for many, many people who qualify. and is a good option for you to consider when trying to determine what mortgage loan is best for you. My cheat sheet for today is, you guessed it, what do you think it's going to be? USDA RD cheat sheet. So I'm going to drop a cheat sheet in the links below the video to kind of help with some things you should know about the program and some data points that you can keep handy, print for later in case you don't have access to this video at a different time or just don't have the time, to watch it, but you want to kind of look at some of those things to refresh your memory. I'm going to drop that in the link below for you guys. I love to hear from you all. I want to hear from you guys. So drop me a comment below. Type yes if you think that an RD loan is good for you or someone you know. Hey there, happy homeowner or happy future homeowner. If you like this video, please be sure to give it a like. I'd appreciate if you would subscribe to the channel, and I'm going to drop some other videos here that you guys can check out in the future if you would like. And please, I'd love to hear from you. Let's connect on social media. My Instagram is _the real Stephanie Weeks.